Good afternoon, ladies and gentlemen. Welcome to Ecobank's half-year 2021 earnings call. This call is being recorded. Your lines will be muted for the duration of the call. I am joined this afternoon by our Group CEO, Adeyemi, Group Chief Financial Officer, Ayo Adipojo, and Group Chief Risk Officer, Eric Odiambo, who will be discussing our half-year results and answer your questions. Please note that some of the statements we are making today are forward-looking and are based on our best view of the world and our businesses as we see them today. For more information on forward-looking statements, please refer to the disclaimer at the back of the slide deck. During the Q&A session, if you wish to ask a question, please raise your hand and your mic will be unmuted. Then kindly state your name and organization. We will now go live to the presentation. Please stand by. At this time, I would like to turn the call over to Ade. Please go ahead.
Thank you, Ato, and good afternoon, everyone. I'm delighted to provide you today with a brief update on our half-year results, the operating environment, and progress on our strategy priorities. Yesterday, we announced our results for the first half of the year, which indicated the firm's ongoing success in driving its execution momentum agenda with sustained resilience in deriving expected returns. For the period, we delivered a return on tangible equity of 16.1, which was above our cost of equity. We increased diluted earnings per share by 19% and our tangible book value per share by 6%. Our profit before tax of $210 million was an increase of $40 million or 23%, benefiting from positive jaws and sustained gains on cost efficiency. The operating environment in which we delivered these strong results was volatile. The third creeping wave of pandemic on the continent threatened economic recovery, which had received boosts from vaccination rollout and needs of lockdown restrictions. That said, for the half year, Sub-Saharan Africa enjoyed relative macroeconomic stability, underpinned by rising oil and commodity prices, moderate exchange rate movements, and accommodative monetary and fiscal policies. As a result, the IMF is projecting a GDP growth to rebound to about 3.4% in 2021. We did grow our revenues by $54 million or 7% to $825 million from a year ago, with a strong momentum in all our business lines. The easing of lockdowns reinvigorated consumer and business activity, especially among the SMEs. As a result, revenue growth in our commercial bank increased $24 million or 13%. The consumer bank revenue rose $11 million or 6%, while our FICC and trade businesses drove revenue growth in corporate and investment banking. Consequently, we saw an increase in both funded and non-funded income. On the funded side, record growth of $1 billion in US customer deposits to $19.1 billion during the second quarter help lower our cost of funds. On the non-funded side, encouraging signs of spend activity resumed, boosting revenues in our payments business by 20% to $90 million, with a solid growth in business payment activity and card spend. We're pretty pleased with the success we are making on our cost efficiency initiatives. Hence, expense for the period fell $10 million or 2%, and we achieved a cost-income ratio of 58.7%, pushing closer to our 55% near-term goal. Pre-tax, pre-provision income, as a result, grew by $64 million or 23%. And with a heavier credit portfolio, we need to build impairment reserves. The need to build impairment reserves has reduced, allowing more revenues that we earn to flow to the bottom line and enhance our per share growth. Turning to the balance sheet, we have ample liquidity and we have taken actions to improve capital buffers. In addition, the investment we made and continue to make in digitalization is helping drive record customer deposit growth. But loan growth remains tepid as economies slowly return to normal, leaving us with ample liquidity, as reflected in our loan-to-deposit ratio of 49.4%. We stand to benefit immensely once economic growth firms up. We plan to steadily increase our loans in the second half of the year, with some emphasis on SMEs subject to meeting our defined risk appetite. And in corporate bank, we expect to ramp up our share of letters of credit and, of course, grow our trade assets. Credit continues to be relatively healthy, as evidenced by the improvement in our non-performing loans to 7.4% from a 9.8% a year ago, thanks to effective problem asset resolutions through collections, recoveries, and some write-offs. Overall, we are confident about our progress towards driving the NPL ratio towards 5%. Similarly, as we previously indicated, driving the NPL coverage ratio above 90% is a near-term goal. We are proactively building impairment reserves and effectively driving our recovery and collection strategy. That said, our Stage 3 loans are adequately collateralized as we hold an underlying portfolio of physical collateral which provides additional buffers. Our capital ratios have improved thanks to continued earnings momentum. In addition, so far moderate exchange rate movements have limited the net impact of foreign currency translation effects on equity for the period. More importantly, however, we raised $350 million Tier 2 sustainability notes, the first ever institution in our part of the world to do so. These notes are also first in sub-Saharan Africa outside South Africa in Basel III compliant 10 non-core 5 structure in a 144A reges format. This together boosted our provisional estimates of Tier 1 and total capital ratios to 9.8 and 14.7%, respectively from 9.4 and 12.3 a year ago, at the end of year 2020. We've made substantial progress in all fronts regarding the strategic priorities we laid out at the end of 2020. My previous remarks have addressed most of them, from encouraging revenue expansion, efficiency gains, credit quality excellence, growth in our payment business, FICC and trade assets, and the generation of long-term shareholder returns. We are also continuing to focus on driving our payments and remittance businesses, in part by expanding our various partnership initiatives. In addition, on collections, we'll be increasing our point-of-sale terminals significantly. These POS will come equipped with QR code capabilities and merchant cash advance features and help boost our merchant acquiring business. Our Ecobank Pay value proposition will benefit immensely from these initiatives. With operations in 33 African countries and support from our proprietary switch and technology company eProcess, Ecobank can drive seamless cross-border payments across Africa. We are diligently working on several exciting partnerships, including in e-commerce. In addition, we continue to drive our rollout of prepaid and debit cards to increase the share of wallets of our consumer spending. Building symbiotic partnership will be critical in our customer acquisition and earnings growth drive, particularly in our consumer banking business. With our significant investment in technology over the years, we will continue to leverage this to serve evolving needs of our customers by partnering with fintechs and telcos and providing them access to our digital platform. The issuance of the $350 million sustainability note demonstrated our commitment to driving social impact, through sustainable investments. We are focusing on several initiatives, including Elevate, our program on women-led businesses, as well as education, health, and green lending. Furthermore, we've committed to train micro, small, and medium-scale enterprises on financing. We've rolled out these financing programs in 8 countries and have earmarked up to $500 million MSME financing across our footprint over the medium to long term. To wrap up, we are proud of the continued progress we are making in our strategic priorities. Our performance once again showcases the power of our diversified business model. For example, solid returns in our Anglophone West Africa and Francophone West Africa and CESA region offset relatively lower returns in Nigeria due to non-linear interest rate movements that happened in Nigeria, while substantial revenue growth in commercial and consumer complemented modest revenue increase in our corporate and investment banking. We are fully cognizant of the downside risk the Delta coronavirus variant could pose to economic recovery in Africa, especially when only 1.3% of our population are fully vaccinated. However, we remain focused on serving our customers diligently and achieve our 2021 guidance notes. I remain deeply grateful to all our stakeholders and our clients and thank them for trusting Ecobank for their diverse banking needs. Thank you. I will now hand over to Ayo, our Group CFO. Ayo, over to you.
Yeah, thank you, Ade, and good afternoon, everyone. Turning to slide 8, which is on key performance indicators. We reported profit before tax of $210 million, just like Ade mentioned, up $40 million or 23%, mainly driven by the positive operating leverage and partially offset by higher net monetary losses. As a result, the return on tangible equity of 16.1% outpaced the cost of equity, and our per share tangible book value increased 9%, while the diluted earnings per share rose by 16%. Revenues were up by $54 million or 7% on an expanding revenue base across our products and businesses. Our operating expenses reduced by $10 million or 2%, indicating a decreasing cost function curve. Our cost-income ratio improved to 58.7%, a record achievement demonstrating our fierce commitment to expense discipline. Additionally, if you look at our cost-to-asset ratio, it has been falling steadily. Turning to slide 9, this slide fully reflects the narrative around the positive operating jaws of circa 950 basis points. It also shows the year-on-year movement in our income statement line items, which I had previously touched on. So I'll move to slide 10, which shows a breakdown of our revenue. Here I'm going to touch on the key drivers of the $54 million growth in our revenue. First, $26 million of that growth came from our net interest income, which increased by 6%, driven predominantly by decrease in the interest expense. The decline in interest expense benefited mainly from an increase in the volume of our non-interest bearing liabilities, while getting support from a 2% growth on the interest income line. We delivered record growth in customer deposits of $1 billion during the second quarter of this year, and on a year-on-year basis, our customer deposit grew by $2.4 billion. I must mention that 97% of the year-on-year growth in our customer deposits actually came from our low-cost deposit bucket of current and savings accounts. Due to limited loan demand, an increase in the investment in low-risk government securities, our net interest margin marginally compressed to about 5% within the period. The easing of lockdowns and social distancing restrictions drove an uptick in consumer and business activity, which helped drive the non-interest revenues to grow by $27 million or 8%. The fees and commission income increased by $16 million or 9%, driven by gains in fees on funds transfer, fees generated on digital transactions, including mobile money payment and current account servicing fees. Net trading income, however, fell by $3 million or 3% on lower client-related FX sales, which was affected by the supply chain bottlenecks and also the subdued overseas travel. Moving to slide 11, which showcases our payments business revenue. We are pleased with the performance of our payments business. Revenues increased by 20% to $90 million and accounted for 11% of the group-wide revenues. Again, the moderate uptick in the consumer and business activity drove transaction activities on all of our digital platforms. For example, the revenue on our disbursement platforms that help our customers to make payment for services critical for their businesses increased by 40% and constituted 50% of our payments revenue. Card solutions revenue rose by 9% as we ramped up issuance of debit and prepaid cards to our customers, and spend activity rose modestly. Our merchant acquiring business received a significant boost from the aggressive deployment of Ecobank Pay to merchants and an increase in the number of point of sales terminals. As a result, revenues increased by 83% in our merchant acquiring business. We have a host of other exciting initiatives in the pipeline, including the enhanced Express account, merchant QR codes on POS, partnerships with fintechs and telcos, all in a bid to monetize our platforms, grow customers, and boost our earnings. Now I move on to slide 12, which is on the digital channels volume. We have included this slide to provide you with a sense of the substantial growth we see on our digital channels. Transactions on the app are up by 88% to $2.5 billion. We are driving growth on our agency network, which is called the Express Point, which we now have in over 90,000 locations in Africa. We saw healthy small business activity, which helped drive a 185% growth in transactions on OmniLite. Also, our omni-channel strategy is delivering results, and despite a reduction in non-strategic physical branches, we continue to see transaction values within branches increase. Turning to slide 13, on our cost to income ratio, this slide reflects the hard work we have put to continue to drive our costs down over the years, especially when revenue headwinds persist. Our ambition to get our cost to income ratio to approximately 55% is on the horizon. We delivered an efficiency ratio of 58.7%, lower than the 64.1% recorded a year ago. Even on a quarterly basis, our efficiency ratio has been declining as we continue to prioritize expense discipline. I must mention that this is the first time that we're printing a cost-to-income ratio that starts with a 5 handle in a very long time. The cost-to-average asset ratio depicted on the graph at the bottom of the slide also shows the cost efficiency gains we continually achieve. Now moving to balance sheet trends on slide 14. The key takeaway here is the continued significant growth in our customer deposits. Deposits were up in the second quarter by $1 billion to $19.1 billion, the most significant quarterly jump in deposits since the fourth quarter of 2017. On a year-to-date basis, deposit grew by $846 million or 5%. The deposit growth we are seeing is broad-based across businesses and geographies, the bulk of this coming from low-cost deposits. Given that loan growth remained tepid, we deployed most of our deposits into relatively safe treasuries and investment securities. However, our borrowings went up primarily due to the Eurobond transaction of $350 million that Ade earlier mentioned. The movement in terms of interest rates and also currencies drove the year-to-date decline in the shareholders' equity. Moving to slide 15, the group remains capitalized at levels above minimum regulatory requirement, a Tier 1 capital ratio of 9.8% and total capital ratio of 14.7%. These are estimates as we're yet to submit June 2021 capital ratios to our regulator. The increase in capital ratio is primarily due to the internal profit generation and also the issuance of the $350 million Tier 2 transaction done in the previous month. On a fully loaded basis of IFRS 9 Day 1, the group estimates Tier 1 capital ratio to be 9.1 and total capital ratio to be 13.9% as of the end of 30 June 2021. Now, I will briefly touch on the performance of our lines of business and regions in the following slides. On slide 16, revenue in our commercial bank increased by $23 million or 13% to $198 million on the back of solid growth in both funded and non-funded income. As a result, the profit before tax jumped up by 34% to $35 million. The net revenue of about $200 million in our consumer bank business increased by $11 million or 6%, which was driven by fees and commission income. As a result, the PBT rose by $14 million or 67% to $36 million. At the same time, we delivered revenue growth of $3 million or 1% in our corporate and investment banking business, which was relatively modest, driven by growth in our FICC and also our trade businesses. Turning to slide 17, which speaks to the region, the key takeaway here is the robust generation of earnings in our regions. The Francophone West Africa region delivered a profit before tax of $87 million, which is an increase of $12 million or 16%, driven primarily by the positive operating leverage offset partially by an increase in impairment charges. As a result, the annualized return on equity for the region was about 21%. Nigeria reported a profit before tax for the half year of about $10 million, which was lower than last year, driven primarily due to the non-linear interest rate movement in the country. The return on equity for this region remains low. This is a region that reasonably presents an upside opportunity for the group. The capital issue has been largely addressed, with the affiliate having a capital adequacy ratio of about 20%, twice the regulatory minimum. We're following up through on plans on improving the performance and also the asset quality metrics. The Anglophone West Africa business recorded PBT of about $121 million, which was up by $24 million or 25%, also driven by the positive operating leverage with a return on equity of about 27%, the highest in the group. The PBT increased by $10 million in our CESA business, which is driven also by the positive operating leverage that we're seeing across the region. And the return on equity improved quarter on quarter from the 17% in quarter one to about 19% by the end of the half year. At this point, I'll now turn over to Eric to take us through the slide on the risk management. Thank you.
Thank you, Ayo. Once again, thank you all for joining our call today. I will now walk you through the performance of some critical risk and credit portfolio metrics. Overall, we've seen an improvement in credit conditions with key indicators either stabilizing or improving. In addition, the easing of lockdown and movement of people and goods and services across most of our geographies compared to 2020 did provide much needed support for a modest uptick in business activity in the past 6 months. Nevertheless, we are keeping a close eye on developing trends with the Delta variant of COVID-19 and the very low vaccine availability in our region, as they may pose a downside risk to the stable outlook. Turning to slide 19. The key message here is that our focus on reducing the stock of non-performing loans through multiple efforts, including effective problem asset resolutions, is paying dividends. As a result, the credit portfolio is much better positioned. Net impairment losses for the half year amounted to $87 million compared to $83 million in the first half of 2020. The marginally higher impairments of the current period reflected the sustained impact of COVID-19 on the economy, which flowed through to 2021. Loan recovery efforts continue to be effective, with recoveries increasing by 12% compared to prior year, helping to partially offset gross impairment charges. Included in the current period's impairment charges is a macro overlay of approximately $15 million taken centrally, which provides an additional buffer against potential downside risks. While impairments continue to reflect the uncertain macroeconomic environment, the pace of our recoveries increased during the second quarter. As a result, the cost of risk decreased to 1.8% from 1.97% in the first quarter. As I noted earlier, effective asset resolution actions have supported the reduction we see in our NPL stock. At $696 million, NPLs are at their lowest since the third quarter of 2015. The NPL ratio, as a result, had improved significantly to 7.4% from the 9.8% we reported a year ago. However, with a near-term target of 5 to 7% NPL ratio, we continue with our efforts to reduce NPLs through multiple processes. We are also on track to achieve NPL coverage ratio above 90% in the near term, up from the 86.7% we've reported as of 30th of June. Turning to slide 20, this slide shows movements in the three classification stages of our gross loan book. In stage 1, new loans of $526 million and loan upgrades of $108 million from stage 2 contributed to the total increase of $635 million. Repayments of $448 million, loan downgrades of $143 million, and FX impact of $237 million contributed to the reduction of $828 million in stage 1. Within the stage 2 buckets, $229 million of loans represented reductions through repayments and, in some instances, upgrades to stage 1 and downgrades to stage 3. The $132 million increase in stage 2 loans represents downgrades from stage 1 and, in some cases, upgrades from stage 3. In the final stage 3 bucket, the $197 million reduction is made up of recoveries and collections, as well as write-offs of $84 million during the period. The $144 million represents new NPL formation during the period to June 30th, 2021. Turning to slide 21. Our group liquidity profile is resilient, with ample liquidity to take advantage of opportunities when economic conditions improve. The predominant message here is a significant growth we have seen in customer deposits, and which Ayo alluded to, particularly in non-interest-bearing deposits and demand deposits. This growth is singularly bolstering our liquidity profile, as reflected on this slide. Moving to slide 22, this slide shows that our loan book is diversified and shifted from high concentrations evident in the recent past, reflecting the effort over the years to reduce our oil and gas exposures. The loan book is now skewed towards corporate borrowers, currently making up 72% of the loan book, followed by commercial bank borrowers at 16%, and finally by the consumer bank borrowers at 12%. Turning to slide 23, on a regional basis, Nigeria continues to have 62% of the non-performing loans. However, it is pertinent to note that the NPLs in Nigeria are lumpy, with the top three names constituting 65.4% of the 428 million total non-performing loans. Also worth noting is the fact that the gross NPLs in Nigeria dropped from $486 million a year ago to $428 million as of June 2021. The NPL ratio now stands at 16.96% from 20.17% a year ago. Resolving just one of the large NPLs for Nigeria, as we expect to do in the near term, represents 340 basis points drop in the NPL ratio. Significantly supporting the NPL story is the recovery we see in oil and commodity prices, especially in oil prices, which provides an upside for investments and cash flows for those challenged borrowers. I would also like to add the fact that across the group for the stage 3 non-performing loan book, we hold a variety of underlying physical collateral, which at a discounted or fair value amounts to more than $400 million and more than covers the open position that is not covered by impairments. Moving on to slides 24 and 25, I would like to conclude my presentation by briefly touching on the rationale for issuing the sustainability bond, which was anchored by FMO at a 50 million commitment. The GCEO already provided an overview and nature of the sustainability bond issued in June 2021 and which is currently listed in the London Stock Exchange. The final order book was 3.6 times oversubscribed at just over $1.3 billion. The issue closed at a yield of 8.95% and was issued at a discount with a coupon at 8.7%. The interest for the bond was global, with investors from the UK, the US, Europe, Middle East, Asia, and Africa. In line with ETI's long-standing commitment to sustainable financing as part of our core values, this issuance enables us to align our funding strategy with our sustainability objectives, which include contributing to UN SDGs, diversifying our investor base, and enhancing DFI collaboration on the continent. We aim to expand on our already existing sustainability financing, where our portfolio currently stands at $670 million. We look to allocating part of this in the green categories, which we aim to double to around $170 million. This will include renewable energy, green buildings, sustainable water and wastewater management, and clean transportation. We also look to allocate funds to social categories and expand on the eligible assets in that category. These include health services, basic infrastructure, access to education, and affordable housing. As part of our commitment, ETI will be providing regular allocation and impact reporting on use of proceeds for eligible assets. Thank you. I now hand back over to Ayo, who will take you through our guidance and midterm targets.
Thank you, Eric. I'll now turn over to slide 26, which provides an update on the progress on our year-end guidance. In terms of the broad ratios and also our commitment towards loans and deposit growth, our revenue and operating expenses, we are largely within the guidance that we gave at the beginning of the year. There are two ratios which are currently outside of the guidance, but we expect that by the end of the year will be within the guidance that we've provided. And these two ratios are the NPL ratio, which is currently at 7.4%, and we expect that to fall within the guidance of between 5 and 7%. And our NPL coverage ratio, which is currently at 86.7%, and we expect that to be above 90% by the end of the year. The following slide, on slide 27, lays out our medium to long-term target, and there are strategic levers in place to achieve all of this. So to wrap up, we have provided our summary takeaway on slide 28, which reiterates the strong growth in returns above our cost of capital, decent revenue growth, heightened focus on our payment business to drive earnings, and the continued expense discipline across all the business lines. The economic outlook remains largely uncertain because of the Delta variant. However, we'll be focusing on driving growth in our payment business, our trade and FICC businesses. Finally, as noted earlier by Eric, we'll continue to drive down the NPLs. So with this, we'll be happy to take your questions at this point in time. Over to you, Ato, to moderate the Q&A session. Thank you.
Thank you, Ayo. Once again, ladies and gentlemen, if you wish to ask a question, please raise your hand and your mic will be unmuted. Then kindly state your name and organization. Thank you. Muyiwa.
Good afternoon, gentlemen. My name is Muyiwa Oni from SBG Securities. Thank you very much for your time and taking our questions. So I have a few questions. The first is, I would like you to elaborate on the loan growth expectation. So I know you had highlighted in the presentation expectations for a pickup in loan growth in the second half. So I just wanted to understand where things were, from your interactions with clients, what demand levels was for credit growth, and also how demand sits across the various clusters. And then also wanted to get your take on what you see as the highest risk at this point in time. So understand that there are clearly concerns with the economic position with the pandemic, but wanted to understand where things were at this point and going forward. And for Nigeria as well, I just wanted to get a sense of where the challenges are currently. So lower net interest income year on year, but wanted to understand beyond the interest rate environment, what other challenges you face in that space. So I know asset quality has been an issue, and just wanted to get a sense of how you see things evolving from that point of view. And then thirdly, on asset quality, you highlighted 3 names in the Nigerian cluster contributing to a reasonable proportion of your NPL ratio. So I just wanted to get a sense of likelihood of a resolution with those challenge names and an outlook on that. And those are my questions. Thank you.
Okay, thank you, Muyiwa. I'll start with the last one, and in case I miss out on the other questions, my colleagues will step in. In terms of the Nigeria large names, what we are trying to demonstrate there is the lumpiness of that portfolio and a pathway in terms of resolving it, in the sense that if we resolve one of the material names that we are engaged with, we will suddenly see a significant drop in the NPL ratio. And just to give you a general example without going into too much details, one of these names had gone through an investment process which was meant to be concluded by the end of 2019. And had that happened in 2019, they would have gone into production and started generating cash flows at that time. Unfortunately, with the advent of COVID, those who are supposed to travel into the country and commission the plant were unable to do so. And this was a situation throughout 2020 and coming into 2021. The most recent update is that with the opening up, that plant was commissioned, has started production, cash flows have started coming through, and it is our estimation that with a certain track record, we will be in a position to make a good recommendation to have that name lifted from stage 3 into a performing asset, initially stage 2, and ultimately into a stage 1 asset. And that's one example of such a lumpy asset which we expect to help resolve and reduce the NPL ratio. We've had similar incidents, and that's why I referenced a reduction in the NPL from 480 levels last year to the 420 levels that we are in today. And there are a couple of other such large names which we believe are within scope of getting us to reduce the NPL ratio. In terms of the loan book growth outlook, I think we've mentioned before getting to a $10 billion level, and we believe that this is something we should be able to achieve in the second half of 2021. That expectation is coming from across the group. We are seeing the larger component of it coming from CESA, that is our Central, Eastern and Southern African region, and UEMOA as well, and slightly lower levels coming out of our and out of Nigeria. The nature of the demand for loans is also quite widespread. From a needs basis, we are seeing high demand in terms of trade finance. There is also demand coming from the need to build up capacity in production. There's demand coming from the agricultural front, which is something we are keen on supporting and financing. And lastly, there's a lot of demand also coming from infrastructure. This is underpinned from the public sector, and it's infrastructure that goes beyond the usual roads and bridges, but also putting up, for example, industrial estates and processing zones for containers and which also handle imports and such type of build out. And we believe that just financing and participating in that kind of investment is good, not just for the bank, but also good for the countries that are participating in them. I think your other question was in terms of what we consider to be a risk or risk profiles. Apart from COVID itself and the impact of COVID in the economy, I think widely we can look at areas such as disruptions or disturbances in a political or social sense. And I mean, if you look across Africa, there are certain countries that get impacted by these issues, whether it's insecurity or insurgency and the economic uncertainty that brings with it. We, of course, have to watch out for that quite carefully and not find ourselves in a situation where this translates into non-performing loans. I think the other issue, of course, is to always keep an eye, because we've come from this situation of high concentration in certain sectors, and just make sure that in terms of going forward, we do not fall into that kind of trap again, where there's high concentration that becomes vulnerable to external factors that are beyond the bank's control. I don't know if I've left out something. Ayo and Ade could step in.
Thanks. I think you covered it. The only question he asked is about Nigeria challenges. I think so you're from Nigeria, and you can see a lot of progress that the country is making in addressing the macro stability and ensuring that the country gets to a very stable macro environment. But the challenges and the way it's been dealt with, which could be rational, has left us with a significant non-earning assets in Nigeria. Nigeria carries 75% of our CRR across the group, though it's 20% of our customer deposits. So that gives you a sense of the opportunity that Nigeria presents as the macro environment becomes normalized. I think that answers all your questions, but we can take more if there's anything not covered. Thank you. Ato, back to you.
Thank you, Ade. The next question will be coming from Jerry Newbill. Your line will be unmuted. Go ahead, Jerry.
Yeah, hi, thank you for taking my question. I think I would just like to follow up on the previous conversation concerning Nigeria. Right, so you said that it has a large base of non-interest earning assets. So does that explain why we are saying that Nigeria contributes almost 30% of the group loans, but it's not really translating to interest earnings? I mean, if you look at where Nigeria is compared to other regions, significantly it is low, in terms of interest earnings. So is that the explanation for that? Because I was going to ask about that. Secondly, I would also like to speak specifically to Q2. In terms of Nigeria, we're seeing PAT of 2 million, and Q1 was about $8 million. That again, considering the fact that you grew assets in Nigeria during the period. So what really drove that decline, especially for the net interest income leg? Then moving on to costs. So I see a 7% decline in staff-related expenditure. I would like if you can throw more light on that, because we don't get to see that every day. Staff expenses. So if you could shed more light as to the details of that, that would be helpful. Is it one-off? And are there other drivers, the expense pullback that we saw during the period apart from staff-related expenses? Yeah, I think those are my questions, really.
Okay, thank you. When I said non-earning assets, it's not just loan. I talked about CRR deposit. That's 75% of the group CRR, though Nigeria is 20% of the group's customer liability. That gives you a sense of the non-earning asset that is sitting in Nigeria, which is because of the macro situation, which is being resolved, and therefore that gives you upside potentials in Nigeria. And that is what we expect that to become. We spoke about the non-linear movement in interest rates. You agree with me that the interest rate has not been linear in its movement. And when it is not linear in its movement, in the quarter in which there are significant jumps, it does impact the interest earning capacity of banking businesses. The movement that has happened in the interest rate in Nigeria has been non-linear. The staff expenses, we did talk in the last quarter of 2020 regarding the fact that we took some of difficult decisions that we needed to take as a group to ask some of our staff that is no longer required for the current business model to leave the firm. And that in the year in which you take that decision, you pay for them the exit cost, and the following year you reap the benefit. So there's a benefit that we are reaping now. As we go into the future, what we want to start seeing more and more of is the fact that you start seeing revenue been expanding, costs been reducing, though at a less rate than where we are today. Overall, the margin of the firm should start expanding beyond what it's been historically. For the first time, as my colleague said, we are now with a 5 handle on our cost-income ratio, and that should drop as we go into the future with earnings as well as cost actions. Thank you.
So your next question will be coming from Damilola Olupona. Oh, go ahead, Dami, please.
All right, thank you very much for taking my questions. My name is Damilola Olupona from Chapuyo Dynam. I have a few questions to ask. Please permit me to take you back to the statement made on your NPL ratio, where you said you had 3 major obligors, which account for a large chunk of your NPL. So my question is, do you expect the reclassification to come in this year? If not this year, can you please put a timeline to when you expect, that large obligor, when you expect an upgrade of this particular loan? Then secondly, I would also like to speak to the cost to income ratios of your Nigerian business. So I realize it's currently above 80%. I know you have touched on some of the reasons why that was elevated, but I noticed that even in the past quarters, we've also seen this come to play. So can you give some sort of outlook on how you expect to resolve that problem, and if possible, also give timelines as well? I also want to ask that we've started seeing improvement in your CRR, which is very commendable. We're also seeing improved asset quality as well. When will this improvement start to translate to resumption of dividend payment? And finally, you spoke about growing your loans in the later part of this year. What sectors are you looking to grow your loan book? Thank you.
Okay, thank you. I'll take the first and last question, and my colleague I will take the one on cost and the CRR. In terms of when we expect to see an upgrade. So first of all, I need to make it clear that we are not just focusing on these 3 names. We are looking at the entire spread of non-performing loans that we've reported as of June 2021. Now, on a couple of these large exposures, there is the possibility of upgrading this year. That depends on how quickly we can establish a track record, a credible track record of cash flows and payments, and make a convincing case, because these are transactions that we also need to discuss with auditors at the end of the year. On the flip side is, these are also names that we are constantly discussing for other refinancing options. And if they do get those refinancing options and are able to refinance part or most of our debt, then there's the possibility of upgrading or removing them from the NPL stock even earlier. So there is no set period. What I can say is that the trend we've seen from last year to where we are today, I believe will continue for the second half of 2021, where we are reducing NPL stock levels and also bringing the NPL ratio for Nigeria down gradually beyond, or rather below, the 16.9 level where we are today. On the issue of the loan books and where we expect growth, I think I touched on that briefly. First of all, the growth will come from across the regions, the 4 regions, including Nigeria, AWA, CESA, and UEMOA. We expect the bulk of it to come from CESA as well as UEMOA, and parts of it to come out of our Anglophone and Nigeria as well, which, as you saw, is also seeing an increase in the loan book. And in terms of the segments where we expect to see this growth, first is trade finance. There is what we consider to be pent-up demand that now needs to be filled coming out of the pandemic, where customers are looking to finance imports of all natures. That's going to come in. Towards the end of the year, when we finance commodity growers like cocoa and cotton and so on, there's growth in that area that's coming in. A lot of companies are also looking to increase their capacities through refurbishment of new plant and lines. That's another area where we expect growth to come from. But one that is also important and usually comprises the largest growth is in the public sector. And this has to do with infrastructure development, where governments are looking to provide expansion in different types of infrastructure, whether that be roads and networks, or in providing space to enable businesses and investments to take place, like industrial parks, for example, inland container depots, and those kind of projects, refurbishing ports, and so on. So we are seeing those kind of transactions coming through, and we expect that to continue throughout the rest of this year and into 2022, and this is where we expect the growth to come from. Ayo?
Okay, thanks. I'll take the other two questions. In terms of the cost-income ratio for Nigeria, if I start by looking at the absolute cost level for Nigeria, which we have shown on slide 33, you will see that we recorded a 20% decline in the operating expenses for Nigeria on a year-on-year basis. And most of this heavy lifting has come from the significant decline that we've seen in the cost of running the physical distribution network in Nigeria. So in terms of the actions on cost, it is progressing very well, and the numbers are showing that. However, of course, the revenue has reduced on a year-on-year basis, and Ade has explained all the reasons around the cash reserve requirements in Nigeria, and also the non-linear interest rates in that country. As we resolve those items, as we continue to expand on our trade business, as we continue to expand on our payment business in Nigeria, we'll see a return to growth on a revenue standpoint. Overall, we expect the cost-income ratio for Nigeria for this year to actually start with a 7 handle. We don't envisage that we would close the year with an 8 handle. And in 2022, we would expect the cost-to-income ratio to start with a 6 handle. So just to give you a measure of the progress that we're expecting from the Nigerian business. In terms of your other question on when are we likely to resume dividend payment, as you know, for us, this decision is taken on an annual basis. So at the end of the year, as part of the process of approving the account, so the board would look at the dividend decision. I agree with you that performance has improved in the current year. Asset quality metrics have also improved. Our capital ratio is in a much stronger place right now. And these are part of the factors that the board would normally assess at the end of the year when a dividend decision is being made. We're close to being ready, but we'll be able to give a much better update at the end of the year. Thank you.
And our next question is from Jerry Nubil. Please unmute. Jerry.
Yeah, hi. I'm Jerry again from Cardinal Stone. I just want to ask concerning your payments business. So We know that in the last few years, you've made that a pivotal aspect of your business, and we've seen the kind of growth, tremendous, if I may say, over there. But now we're seeing new entrants, we're hearing Access, GTCO, wanting to play strongly in that aspect of the business, also on an Africa-wide scale. How do you think, you'll be able to protect your market share in that regard? And so that's one. And then secondly, you also did say that concerning payments, Nigeria will also be a strategic focus. Have you seen any improvements in Nigeria, as far as that's concerned?
Okay, let me answer. GT and the rest of our colleagues are strong competitor. It's always good to be able to compete with strong players. So we believe that we've been at this for a while. We have 33 banking licenses across Africa. We've had Holdco since inception, and therefore we've been having a centralized data center for a very long time. We believe that we are ahead of the curve in giving access to other players to be able to access Africa-wide switch in a one go. So we believe we have a lot of advantages that we can press, and we are pressing. That's why you will see that our customer deposit is significantly more than that of our nearest competitor, bar people that are competing out of South Africa. But we are aware of the nature of the market. It's a red ocean, but we believe that we have enough competencies and capabilities and assets to be able to compete to win. You asked the question about Nigeria, whether we are seeing progress in our payment business. The short answer is yes. We are seeing that, and we're seeing that because of the active actions that our team is taking in Nigeria that is driving market share, and we will be in a position to disclose more of that as we go towards the end of the year. But we are seeing real progress in terms of our payment business in Nigeria. And remember that one of the good things about Ecobank is ability to scale rapidly from one location. That can give us both a volume advantage, cost advantage, and significant advantage, because we are not playing in only one country. Anything that works in Nigeria can scale to 33 countries almost instantly. So those are the things that we bring to bear. And when we are talking to a lot of people, whether it is fintech, the MNOs, and other players that are looking at platform to be able to do payments across Africa, multi-geography payment platform, they are approaching us because they know they don't have to implement in multiple countries, because we don't have multiple data centers. Thank you.
The next question is from Solina. The line will be unmuted. Go ahead, Solina. Solina?
She's not yet unmuted.
Okay. Okay.
Solina, can you unmute yourself?
Oh,
There
yeah.
you go. Okay.
Sorry. Hi,
Okay.
sorry. Good afternoon, everyone, and thanks a lot for taking my questions. I've got two questions. So the first one, sorry if I've actually missed that point, but it's on the loans still benefiting from the COVID-19 relief measures. If you could let us know what is the current amount versus the end of Q1. And also if it goes like in line with your expectations in terms of performance for what you were expecting for year end. And my second question is at the Holdco, if you could give us a bit more color on the double leverage ratio and your liquidity, so in terms of cash and interbank placement with affiliates for your interest coverage. Thank you.
Okay, thank you, Selina. I'll take the first question, and my colleague I will cover the next one. Talking about the COVID relief, last year at the outset of the pandemic, as you know, most governments in the US and Europe were able to intervene and provide direct cash funding to the economy, directly to banks, corporates, and right down to individuals. We did not have that option in Africa. What we saw instead was regulators stepping in to come up with certain forbearance measures which allowed banks to act in a certain way and basically provide moratoriums to their clients, both in terms of interest and principal. We took advantage of that, as did other banks, and in total placed about $1.9 billion of assets under moratorium. That 1.9 billion was split as 400 million for the 3 regions combined and 1.5 billion out of Nigeria. That 400 million from the other regions has basically gone back to BAU performance. A month ago, there was about $40 million that was still under moratorium, but that's expected to run out in the next 1 or 2 months. Of the 1.5 billion that was placed under moratorium in Nigeria, remember this moratorium was running for a period that ranged from 6 months, 12 months, and in the longest incidents, this went up to 18 months. So we've had 600 million of that coming back to BAU business. In other words, resumed with their cash flows, able to meet their requirements and payment requirements from the bank in line with the restructuring that was done. And we then have the 900 million, which still has a bit of ways to go. What is important to mention is of this 900 million, there is already 230 million, which is squarely sitting in stage 3. So apart from the moratorium and tracking that, there is no further downside that would arise from that portfolio. And the balance of around 630 is spread between stage 1 and stage 2, is considered performing. And we continue to monitor their performance during this moratorium period. It is possible that, again, given the circumstances and the lingering effects of COVID into 2021, we may have cases where, based on a discussion with the client and based on approval from the regulator, we may extend that moratorium period for a few more months. But the point to make here is we do not expect a further downside into stage 3 from this portfolio. That is already captured in the reported NPL amount. And what we expect to do is to see resolution of this portfolio back into performing category. I hope that answers your question, and Ayo can take on the other one.
Okay. Yeah, thanks.
Yeah, that's very clear. Thank you.
Yeah. Hi, Selina. So in terms of your other question around the double leverage ratio, you recall that in 2019, our double leverage ratio ended at 155%. We reduced that by about 200 basis points in 2020. It got to about 153%. As of half year, June 2021, we've also further reduced it by about 200 basis points. We're currently at about 151%. So you see that there has been progressive decline in the double leverage ratio in the past 18 months, and we expect that trajectory to continue. So there are a number of other things that we're looking at, and I'm sure in the course of the third quarter we'll be in a much better place to fully tell you what we're looking at. But suffice to say, by the end of 2021, we would expect our double leverage ratio to be well below the 150% mark, and we'll continue to demonstrate the ability to bring it down in the future years. In terms of the other question that you asked around the liquidity, yes, the liquidity of the holding company is a much better place at the moment, and also the expectations around dividend for this year and next year, they still hold. We've collected, a significant portion of the dividend income for 2021. We're just expecting from 1 or 2 countries to complete the total. In 2022, of course, the dividend also would be on the back of the improved performance that we're seeing in 2021. You will see the significant growth we're seeing in our performances in the Francophone West Africa zone and the Anglophone West Africa zone. And these 2 regions, they've been a big contributor to a dividend pool for the group. So we expect our previous assumption to hold, and we'll be in a much better place from a liquidity standpoint. Thank you.
Just one follow-up question. So in terms of cash that you've got currently at the holdco level, what is it roughly?
Yeah, at the moment, we've got over $100 million, yeah.
Thank you.
Thank you.
I think if I can just add to Sulena, I think one of the sources of funding that we don't normally talk about is recovery through the resolution vehicle and other element that is being held in holdco, that recovery goes straight to our bottom line. And our projection over the next 6 to 12 months is that we should get through the various resolution vehicles close to $40 in terms of dollar income. Thank you.
Thank you very much.
Thank you once again, ladies and gentlemen. If you wish to ask a question, please raise your hand and your mic will be unmuted. Then kindly state your name and your organization. Okay, thank you, everyone. That marks the end of the call. Thank you for joining and have a great day.
Thank you, Ato.
Thank you, Ato.
Thank you.